What exactly is the stock market? Think of it as a giant online grocery app for businesses, where you pick up shares or items for your portfolio or pantry. The market building is where all company brands are kept in one place. Investors aim to buy these brands when they are on sale at a lower price. What is a share or a stock? Think of a sheet cake analogy. A trillion-dollar company is cut into billions of bite-sized pieces or shares to make it affordable for everyone. Even though your piece is small, it's 100% real cake, and its value grows if the whole cake grows. Why do companies sell pieces of themselves to the public? Companies sell shares to raise cash to grow faster and find partners. They are building a global empire and need fuel, your money, to reach their big dreams. When they win, you win. Investing is the act of consistently contributing your money to a wealth-building machine. It's a long-term habit of buying pieces of great businesses. Saving is like buying bottled water, but investing is like building a reservoir. You're building generational wealth that can support your family for decades. What is inflation? It's the invisible money eater that causes prices to rise, meaning your dollar buys less over time. Inflation is like a leaky water bottle, where drops of your savings leak out every year. You invest so your money grows faster than the money eater can increase prices. Why invest instead of just saving? Saving is defensive, keeping what you have. Investing is offensive, making it grow. Saving is like putting star players on the bench, safe but unable to score. Investing is putting them on the field to work and earn a paycheck so you eventually don't have to. A brokerage account is a special financial app or toolbox to help you manage, track, and grow wealth. Think of it as a professional greenhouse. A bank account is a dark closet where seeds never grow. The greenhouse provides the soil and environment for your investments to grow for years. What is a share price? It's the current price tag for one single crumb of a company, reflecting what shoppers are willing to pay right now. To find a good deal, you must look at the value in the piece, not just the sticker price. How much money do you need to start? And what are, quote, fractional shares? You can start with less than $100 because fractional shares allow you to buy slices of high-priced companies. This removes the velvet rope for new investors, allowing you to own profit-making power immediately. You make money from investments in two ways: capital gains and dividends. Capital gains are when the value goes up, like a tree getting bigger. Dividends are when the company pays you cash, like fruit falling off the tree. You want a mix of both for generational wealth. Compound interest is, quote, interest on interest. It is the mathematical snowball effect where your money earns a profit and then that profit starts earning its own profit. Compound interest is the engine and your contributions are the gasoline. It builds wealth exponentially. An ETF, or exchange-traded fund, is a basket of stocks. Instead of buying one company, you buy a single share of a fund that owns hundreds. It's like buying a pre-made fruit salad bowl instead of a single pineapple. ETFs are the easy button for keeping your wealth growing. A sector is a specific category of the economy. Broad market ETFs are like a pre-filled cart. Sector ETFs, like the technology aisle, let you shop in just one category. Specialized ETFs focus even more, like the semiconductor shelf. These options let you focus your investments. Risk in investing is the possibility that your investment could lose value. However, the biggest risk is inflation eating your money while you're too afraid to act. Managing risk is like driving with a seatbelt and speed limit. Stay diversified and keep your eyes on the long-term road. Market volatility is the up and down movement of stock prices. It's temporary, normal, and creates opportunities. Volatility is like the drops on a roller coaster, while growth is the upward slope. Don't confuse a dip with a defeat. When prices drop, it's a flash sale, the best time to add to your reservoir.
Think volatility is scary? Zoom out. In the last 5 decades, the market has been positive nearly 80% of the time, with an average annual return of 11.7%. The long-term story is always the same: growth. If you're playing the long game, you're already winning. Hit that follow button for more ways to master the market. Peace, blessings, financial freedom.